Welcome to the Deep Dive. Today we're plunging into the complex and truly fascinating world of Bitcoin as of August 8, 2025. It's a market caught between these powerful, long-term, bullish tailwinds and, well, some very specific cautionary short-term signals.
That's right. What we're seeing is a kind of remarkable divergence. On one hand, a major U.S. executive order could unlock a huge wave of retirement capital,
Big stuff.
huge. But on the other, our on-chain data is signaling what we're calling a bullish cooldown. So this deep dive is all about navigating that tension, understanding the big picture structural shifts versus the immediate market mechanics.
Okay. Our mission today is to cut through the noise, extract the most important nuggets of knowledge from the latest briefings and analyses so you can clearly understand the powerful forces shaping Bitcoin's present and future. Okay, let's unpack this. We're going to kick things off with some pretty significant regulatory and policy shifts in the United States. These aren't just minor tweaks, right?
Yeah.
They seem to be fundamentally altering the risk and opportunity profile for Bitcoin, maybe pointing toward a potential pivot from caution to, well, accommodation.
Yeah, what's truly striking here is the sheer speed and scope of these changes. It's happening fast.
Absolutely. So, okay, first big one. August 7, 2025, President Donald Trump signed an executive order. It's specifically aiming to permit 401k retirement plans to invest in alternative assets, and it explicitly includes cryptocurrencies. Now, this sounds monumental, but what does it actually mean for you, the everyday investor, maybe looking at your retirement fund?
Right. Well, it's not an immediate green light for every 401k to pile into crypto tomorrow. Let's be clear on that. However, it is a profound policy pivot. It formally kickstarts a whole regulatory process designed to potentially unlock a truly massive pool of capital. We're talking an estimated $8.7 trillion in 401k assets.
Wow. Trillion.
Trillion, yeah.
Yeah.
This move fundamentally legitimizes Bitcoin as a component of a diversified, long-horizon investment portfolio. It directly counters that long-standing narrative of Bitcoin being purely speculative. And we're already seeing fiduciaries like BlackRock and TIAA accelerating their crypto-inclusive product development because of this signal.
So it sort of primes the pump.
Exactly. In essence, it could create a structural demand floor, almost like dollar cost averaging, but like on a national scale, which, would naturally dampen volatility over time.
And speaking of regulatory clarity, another, well, seismic event, really, is the official conclusion of that nearly 5-year legal battle between Ripple Labs and the U.S. SEC.
Yeah, finally over.
Finally. The XRP token, Ripple's native asset, jumped 11% to over $3.13 in 24 hours following the news. But why is this so significant beyond just XRP itself?
This isn't just a win for Ripple, though it certainly is for them. It's a significant win for the broader industry because it's the removal of a major unknown, a huge gray cloud.
Right. The uncertainty.
Exactly. Institutional investors especially are hypersensitive to legal ambiguity. The conclusion of this incredibly closely watched case, coupled with other clarifying actions we're seeing from the SEC, it strongly signals a de-escalation, maybe, of their previous adversarial posture. This cultivates a more stable, predictable operating environment for the entire digital asset space, and by doing so, it indirectly de-risks Bitcoin, making it even more attractive as the primary entry point for that institutional capital we were just talking about.
Okay. Yet it's not all clear sailing on the policy front, is it? We're also seeing some actions that present a more, let's say, nuanced picture. The Trump administration has enacted new import tariffs, pushing the average U.S. import tax rate to 18.3%, highest since the 1930s, apparently.
These are the big jump.
And what's particularly noteworthy for us is that tariffs on ASIC mining machines, those specialized computers for Bitcoin mining coming from Southeast Asia, have risen to 21.6%. What kind of impact are we forecasting here? Is this just bad news for U.S. miners?
Well, the immediate first-order effect is undeniably negative for U.S.-based Bitcoin miners. Their CapEx just went up. Simple as that.
Right. More expensive.
Exactly. However, the second and third-order effects are far more complex and actually kind of interesting. Higher hardware costs could actually slow down hash rate. That's the total mining power growth in the U.S.
Okay.
Now, this might incentivize existing U.S. miners to hold onto their mined Bitcoin longer, right? Reducing sell pressure.
Yeah.
It also makes the U.S. less competitive for brand new mining operations, leading to a geographic rebalancing of the global hash rate, which, ironically, could actually enhance network decentralization.
Didn't expect that.
And here's another twist. Existing U.S. miners might even see their used ASIC machines go up in value, maybe by as much as 20%, just because new ones are harder or more expensive to get.
Fascinating. Okay,
Yeah.
so beyond regulations, let's talk about the actual flow of capital, major institutions, even nations. That's a critical indicator of Bitcoin's long-term trajectory. What are we observing on that front?
Yeah, we're definitely witnessing a clear re-engagement and a fascinating evolution in how major players are strategically approaching Bitcoin now.
Like the ETF flows. After 4 straight days of pretty heavy net outflows, over $1.45 billion total, the U.S. spot Bitcoin ETFs saw a big reversal. $91.5 million in net inflows on August 6th, then over $275 million on August 7th. BlackRock's IBAT led the charge. So it looks like institutions are buying the dip. But couldn't this also be seen as maybe a sign of fragility? Like retail sells off, prices dip, and then it needs big institutions to step in. Does that really show maturity or just a new dependency?
That's a really perceptive question, and it's something we absolutely analyze closely. And while, yeah, it might look like a dependency on the surface, this pattern is actually pretty classic institutional behavior. Large professional investors, they always look to buy dips in assets they have conviction in. So the heavy outflows during the price correction, followed by the strong return to inflows as the price stabilizes, it suggests a growing conviction among these large capital allocators that current price levels represent a significant value opportunity. For them, it indicates a maturing market where they have the conviction and the capital to step in. So less about fragility, more about calculated accumulation, I'd say.
Right, calculated accumulation. Okay. Now, shifting gears to something potentially geopolitically huge. Indonesia, a G20 economy, fourth most populous nation, reportedly considering adding Bitcoin to its national reserves. This feels like a completely different league than El Salvador, right?
Oh, absolutely. It is. This is a monumental step beyond El Salvador's legal tender adoption. I mean, that was pioneering, no doubt, but from a much smaller economy. If Indonesia, a major G20 player, proceeds, it could genuinely trigger a geopolitical game theory dynamic. Well, it fundamentally validates Bitcoin's thesis as a non-sovereign, politically neutral, hard money reserve asset. It offers a compelling alternative, or at least a diversifier, to traditionally U.S. dollar-denominated debt held in reserves. This news, even at this early stage, suggests the potential for future, serious, geopolitically driven demand from sovereign nations looking to diversify their treasuries. It's a major signal.
Wow. Okay. And corporate adoption is changing too, it seems. It's not just about putting Bitcoin on the balance sheet anymore. Like UK-based energy firm Union Jack Oil announced a partnership to start Bitcoin mining using stranded natural gas at its West Newton site. This is integrating it right into their operations.
This is where it gets really compelling for me.
Yeah.
Seriously. This represents a significant evolution of the corporate adoption thesis because it's rooted in operational efficiency and, crucially, asset creation.
Right. Not just holding, but making it.
Exactly. For the energy sector, Bitcoin mining provides this mobile, profitable mechanism to convert what is often a liability, wasted energy, flared gas, associated emissions, into a valuable liquid digital asset. It broadens Bitcoin's appeal to an entirely new industrial sector, demonstrating its practical utility as an energy monetization tool, not just a store of value. It's potentially a win-win for energy companies and the Bitcoin network.
Okay, so many bullish signals stacking up. But as we highlighted right at the top, Bitcoin's story right now isn't just about endless bullish catalysts. There's a new, potentially risky phenomenon emerging that warrants close attention. Digital asset treasury firms, or DEAT firms.
Yes, the DATs.
These publicly traded companies plan to raise an absolutely astounding $79 billion in 2025, solely to buy Bitcoin and other cryptos. Some insiders are even warning this could trigger the end of the current bull cycle. What's the concern here? $79 billion sounds like pure rocket fuel.
It does sound like rocket fuel, but this raises an important question for you, the investor. What's the inherent risk? These DAT firms are essentially leveraged plays on crypto prices. They often trade at a premium to their actual crypto holdings.
Meaning their stock price implies their crypto is worth more than it is on the market.
Precisely. And the danger there is a potential cycle of forced selling and contagion. If the broader crypto market dips significantly, these DAT share prices could fall even faster, right? Creating an unstable situation. If a firm's market cap drops below the value of its crypto holdings, it could face immense pressure from shareholders, from lenders, to liquidate its assets to try and close that gap,
Which would push prices down further.
triggering a cascade of selling that would impact the entire market. This represents a potentially pro-cyclical risk building right into the market structure. It demands very, very close monitoring. It's a classic example, maybe, of too much leverage chasing an asset too quickly.
Okay, a lot to watch there. So with all these macro factors swirling, let's now dive into the core market dynamics and the price action itself. Bitcoin's price is clearly caught between these bullish fundamental patterns and, like you said, what seems like conflicting on-chain data, all influenced by market narratives, of course.
This is precisely where we see that tension between different market participants, short-term traders, long-term holders, institutions playing out in real time on the charts.
So Bitcoin's been consolidating, right? Roughly between $114,000 and $117,500. Gains have been modest, trading volume relatively low, which, can often be a precursor to a significant move one way or the other. What do the charts suggest for its next direction?
Well, looking at it technically, yeah, there's a pretty strong support zone established around that $112,000, $113,000 level. Immediate support is near $114,500. Overhead, you've got resistance at $118,000, and then critically, $120,000 is the big psychological level.
Right.
We've also observed what looks like a bull flag pattern forming on the 4-hour chart. Technically, that pattern suggests a target toward $125,000 if we see a decisive breakout upwards. Now, while it's currently trading above key short-term moving averages on that 4-hour chart, if you zoom into shorter time frames, you do see some lingering bearish pressure. And that's contributing to this current consolidation phase, this sideways chop.
Okay. Now, this is fascinating. The on-chain data, as you mentioned, presents a really nuanced story, almost like a tale of two models giving us different views of market health. We have CryptoQuant's bullish cooldown idea versus Cariol's energy value model. How do we square these? They sound kind of contradictory.
Yeah, it seems contradictory at first glance, but this apparent contradiction isn't really a flaw in the data. It actually reflects the behavior of different market cohorts. CryptoQuant's Bull Score Index, which tracks things like stablecoin liquidity flowing in and out and short-term profit taking, it declined from 80 down to 60.
Okay, showing a slowdown.
Exactly. It shows a near-term pause, primarily reflecting shorter-term traders maybe taking some chips off the table, reducing that immediate buying pressure. Conversely, you have Capriol's energy value model. This is based on more fundamental factors like network security, the energy input required to mine Bitcoin. And that model estimates Bitcoin's fair value way up at $167,800.
Wow, so significantly higher than current price.
Right. It implies Bitcoin is currently about 31% undervalued from that long-term fundamental perspective. So this divergence, it's actually the on-chain signature of what we call a healthy consolidation phase. Short-term selling is being absorbed by long-term accumulators, people using that energy value model perhaps, and that's setting the stage for future expansion without needing an immediate dramatic price spike.
Healthy consolidation. Got it. And of course, there's always a narrative influencing sentiments, especially among retail investors. The Bitcoin August curse.
Ah, yes, the August curse.
Historically, Bitcoin has shown weak or even negative performance in August. The average monthly decline is apparently 7.87% since 2013. We even have Rich Dad Poor Dad author Robert Kiyosaki publicly hoping for a crash below $90,000 so he can, quote, double his position. How much weight should we actually give to these kinds of historical patterns and, public pronouncements?
It's a classic example of reflexivity in financial markets. It's actually quite interesting how it plays out.
Meaning the prediction influences the outcome.
Precisely. The widespread publicizing of a potential dip, this August curse, can itself create the very conditions for it to happen, as some traders inevitably sell in anticipation. But simultaneously, it creates this clearly defined cohort of investors like Kiyosaki who openly signal their intent to buy that potential dip.
So they're putting a floor under the curse.
Kind of. They form a potential support zone if the price does drop. So the key for you as an investor isn't necessarily to predict if the curse will manifest, but to understand how the narrative itself is shaping other market participants' behavior. It's partly self-fulfilling prophecy, but also potentially self-limiting because of the buy signals.
Interesting dynamic. Okay, moving beyond prices and regulations, Bitcoin's long-term value is obviously tied to its evolving tech stack, the infrastructure being built around it. What significant developments are happening on the frontier of Bitcoin's ecosystem?
Yeah, and here we're seeing a really clear bifurcation, a split, and it really demands careful due diligence from anyone looking to engage with this part of the space.
Okay, for example, the Bitcoin Layer 2 network, L2, called Build on Bitcoin or BOB, they've successfully raised $21 million total, including a recent $9.5 million strategic round from pretty prominent VCs like Castle Island and Anchorage. That sounds like serious money backing serious tech.
It is, and BOB's approach is both sophisticated and, I think, pragmatic. It operates as a hybrid L2, aiming to combine Bitcoin's unmatched security with Ethereum's DeFi decentralized finance versatility. Their upcoming BitVM bridge is a big deal. It's designed for trust-minimized use of native Bitcoin in DeFi applications. That's a major technical hurdle they're tackling.
So using actual Bitcoin in DeFi more easily.
Exactly, in a more secure way. This funding signals a crucial shift in the L2 space towards professionally managed, well-capitalized infrastructure development. It's specifically designed to attract institutional capital and enable more complex applications to be built on top of Bitcoin, moving beyond just payments or store of value.
Okay, but then in stark contrast to BOB's professional backing, you have another project, Bitcoin Hyper, HYPR, which seems to highlight the risks in this rapidly evolving space.
Right.
It's a heavily marketed presale, claims to use Solana's virtual machine for Bitcoin L2, reportedly raised over $7 million. But it seems like there are red flags everywhere. What should you be looking out for here?
This juxtaposition is absolutely critical for you to understand because, as you saw with the DATs, fundraising success and marketing hype are not reliable proxies for legitimacy or technical substance.
So true.
Bitcoin Hyper has an anonymous team big red flag number 1. No KYC verification, know your customer checks, which are standard, no evidence of a working product, no MVP, minimum viable product, no public testnet, no auditable code. The technical architecture, completely unexplained.
So, just promises.
Pretty much. On top of that, it boasts an excessive $250 million fully diluted valuation, FDV. That's its total potential value for a project with literally no tangible product yet. Its marketing uses tactics linked to past dubious projects, and it makes completely unrealistic staking APY annual percentage yield claims, like as high as 918%.
We got 15%.
I mean, come on. This just illustrates that, especially in these fast-moving spaces like crypto L2s, due diligence is absolutely paramount. Always look for transparent teams, verifiable code, clear executable roadmaps, and realistic claims. Don't get swayed by hype alone.
Sound advice. Okay, finally, let's check the pulse of the foundational layer, the publicly traded Bitcoin mining companies. Hut 8 Corp reported a robust balance sheet holding over 10,600 BTC, valued at $1.1 billion. CleanSpark's Q3 2025 revenue jumped 91% year over year, and their Bitcoin treasury also surpassed $1 billion. What does this financial health tell us about the miners?
This demonstrates a really significant trend, I think. The largest, most established miners are evolving. They're not just transaction processors anymore. They're becoming long-term strategic holders of the asset they mine.
The ultimate HO dealers.
You could say that. Their increasing ability to secure large Bitcoin-backed credit facilities, like Hut 8 getting that $130 million facility from Coinbase, it showcases their growing financial sophistication. This HODL strategy, holding on to their Bitcoin rather than immediately selling it all by these fundamental network participants, is important. It reduces the amount of new BTC hitting the market day to day, thereby mitigating sell pressure and directly contributing to the asset's long-term scarcity and potentially its price appreciation.
Right, a structural support from the miners themselves. Okay, so wrapping this all up, what does this complex picture mean for you as you navigate this market? The past, say, 48 hours have painted a picture of a Bitcoin market in this fascinating transition. We've got a regulatory shift, seemingly moving from adversarial towards accommodative, paving the way for more mainstream adoption through things like 401ks and ETFs.
Exactly. And this powerful long-term structural change is currently meeting that short-term technical consolidation we discussed, mirrored in the on-chain data. You have momentum traders taking some profits, while patient long-term holders and institutions seem to be steadily accumulating during this pause, this tension. It's very common in healthy, maturing markets that are pausing to build a new, higher base.
Makes sense.
But remember, the market never operates in a vacuum. You absolutely should remain vigilant of broader macroeconomic events. Keep an eye on the US CPI data coming out August 13th that will undoubtedly shape Fed thinking. And then there's the Jackson Hole Economic Symposium later in the month, August 21st to 23rd. Fed Chair Jerome Powell's tone there could potentially create new headwinds or tailwinds.
Always the macro context. So here's where it gets truly thought-provoking, perhaps for your own strategy. Given these conflicting signals, short-term dips meeting long-term structural growth and this increasing maturity of institutional players alongside new risks like those DAT firms, Is Bitcoin now becoming less susceptible to the purely emotional retail swings we saw in the past? Is it more influenced now by calculated long-term strategic positioning? And if so, what new frameworks might you need to consider for assessing its risk and reward as it continues to mature into this, well, different kind of asset?